And welcome to Markets at Noon. Let's go across to the management at Mahindra and Mahindra Financial. It's the earnings seasons and we at ET Now keep getting you top managements. Well, let's welcome in the management. Ramesh Iyer, MD at Mahindra and Mahindra Financial Services is now joining us. Congratulations on one of the good quarters that you've seen. Q1 generally tends to see slightly higher gross NPA addition. Can you just talk to us about this quarter? What was the impact of INDS transition?
So clearly, if you kind of look at, the rural sentiments are holding up. They are pretty positive. And as I have been always saying that rural is driven by two cash flows. One is the farm, another is the infra cash flow. We do see that with monsoon sentiments positive and expected to end average plus, I think that's one growth driver for sure where the sentiments are driving it. And two, I think, is at the state levels, you do see different infra activity, maybe caused by a Gram Panchayat spend, maybe a municipality spend or a state spend. And therefore, that's the other cash flow we definitely see is kind of driving positive for us. I think the other factor is we opened about 100 odd branches in the fourth quarter. I think they are kind of continuing to now deliver results from different pockets. We are a significant player in as far as the UV and tractor segments are concerned, and therefore their volume is a benefit to us and we have gained some market share out there. Commercial vehicle has been a very good growth driver for us. Given a low base in the previous year, we are growing at upward of about 80 odd %. Pre-owned vehicle has been the other segment where our growth has been pretty good. And almost all OEMs for LMB, that is the car segment, is reaching out to rural market. And other than Maruti, where we are of course a very significant player, we are also doing cars of the other OEMs and that's adding up to value. So I think if you put all of this together, clearly we believe that the growth driver for us comes from each of these that I mentioned.
Could you also just explain the INDS transition impact on asset quality? Gross stage 3 NPAs have seen a slight bit of risen. QOQ, they have come down, but on a YOY, they are looking on the downside. Can you just explain that impact on gross NPA, broadly on net worth and the earnings?
So kind of if you look at for us, the service income that used to come in have to be amortized, but likewise the commissions or brokerages that we pay also gets amortized. So honestly, on the income front, we have not seen much of an impact as far as we are concerned. But in the NPA levels are concerned, at the level 3 provisioning that we do has actually come down, whereas on the level 1 and level 2, where we normally earlier provided the standard asset provisioning, has substantially gone up because of the INDS impact that comes in. So to that extent, the provisioning has gone up. As far as the gross NPA is concerned, yes, on a quarter-to-quarter basis, there is an increase one would see. But then if you look at from first quarter comparison, it's actually fallen by upward of 2%. And this is the first time that we've seen the increase in the first quarter has been substantially lower than ever before, and on an Indian GAAP basis, if one was to look at it, it's almost remained at the same level, which has never been witnessed for rural economic activity. Normally the first and second quarter is not the best. It catches up in the third and fourth quarter where you have seen correction for us. This being the trend that we have seen in this quarter, we believe that going forward things would look even much better for us, having held the NPA at this level in the first quarter. Third and fourth quarter where the cash flow substantially improves and we get the benefit, I think we should continue to get the benefit and make us look much better.
Disbursement reported a strong growth of 35%. AUMs reported a 21% uptick. While you have covered the reasons for strong growth, how do you see disbursements and AUM growth for the remaining FY19 and the next year?
So far as margins are concerned, our own forecast is that the borrowing cost would go up a little from maybe 25 to 40 basis point over this period of time up to March. But we believe that we have an ability to pass it on to the consumer as the borrowing cost increases. So therefore, we don't see big margin pressure as far as we are concerned. The overall yield would be maintained between 16 and 18% for different products, and therefore leaving us with a return on asset that we forecast would be anywhere between 2 and 3% is what we think is possible to be achieved if the margins are clearly protected. So far as the NPA trend I have explained, and we do see that third, fourth quarter as the cash flow comes in should help us definitely improve over where we are at this stage. That's been historically seen, and we believe that would continue to happen to us. In as far as overall volumes are concerned, I think we are an enabler. We would wait for to see how the volumes for all the OEMs pans out too. We still don't see too much of competition out there in the rural market, and when we say rural, really deep penetration into the villages. We have consumers close to around now upward of 330,000 villages where we have a consumer, and we think that that's a real advantage. And with the 1400 branches that we have, we do see a big advantage to us from a growth perspective. In as far as our prime product like Mahindra UV tractors or Maruti car is concerned, we would hold on to our volumes and get the benefit of the increased volume that the OEMs would put out. And we do believe that there could be slight improvement of market share. That will be one growth story. The pre-owned vehicle that I talked of, we have also now significantly active in the pre-owned tractor segment. And I think that would going to be very clearly our growth driver as far as pre-owned vehicle is concerned, will be the other growth driver.
Lastly, since the share of pre-opened vehicles, CVs improving, how do you see, the recent rise in the truck axle norms and the scrappage policy? What sort of an impact can it have on the business?
See, so far as the vehicles scrappage policy is concerned, talking of 15, 20-year-old vehicle, etc., that shouldn't really impact big time. In fact, it should bring some volumes whenever such replacements happen. But in as far as the axle impact is concerned, I think the OEMs are working on it, and I'm sure that over a period of time that would also settle down and volumes from there would come in. Reading from what the OEMs have said in terms of asset quality based on overloading from their current vehicles, I think the little concern would be, will there be more accidents on the road, will there be insurance claims coming in, etc. But that's something that one has to wait and watch to see what really happens. But overall commercial vehicle segment is not just represented by that one segment where there is an impact due to the axle change. There are other segments from where even the volumes will come. But clearly, as a finance company, we have less to worry in the sense that, only when the OEM does their volume will we get the benefit. And I'm sure OEMs are working hard to see what can they do to ensure the volumes are retained.
Thanks so much, Mr. Ramesh, for taking us through the numbers. Congratulations, as always, on a good set of numbers. Stock, however, is down.